Well, here we are, basically back to number 2 of the life health insurance uh, training course. We're going to start on page 28. The last one, man, it took a long time. I didn't realize it was over 50 minutes. It's a lot of video. Anyway, doing these things, um, I'm grabbing this stuff out of my head as well. And so you'll see information from me to you that I'm not that great in doing two things at one time, but this is what I'm trying to do, help you with your business. So remember before we started, we ended around here somewhere, and I could read all this stuff off, but that do you any good, not for studying anything. But what I'm going to do is I highlight some things in here of my brain to you, and so that maybe a better understanding or life events have happened. So real life scenarios from clients in the past. So, I had there's this company I worked for a little bit. It still is an independent, and they had this thing called mortgage protection. What is mortgage protection? It's life insurance with a critical illness rider, terminal illness rider. So if for some reason you became critically ill, your mortgage can be paid for. Mortgage might be $500,000 or $100,000 or $50,000 or whatnot. People afraid of losing their home. It's really basically life insurance. Okay? And there were actually people that could not get a policy for whatever reason. And we might be able to do an accidental death policy. Not with the benefit rider, not a rider, but an accidental death policy. They're really basically really inexpensive, and it can encompass a lot of people. And an accidental death could be, you might be poisoned by fall. My father died because he fell. My grandfather died. He was in an accident. People die by accident. So, and then the thing about these types of policies, though, is there's limits. Okay, but this particular person couldn't get anything else. You can get an accidental death policy, so you're still helping them. Now, for the agent, might spend a couple hours with this client on the phone, and that's the only thing they could do for them. And you might have made $10, but you helped somebody. All right. So be a good character and help people get what they want. So here's required by law, the entire contract, the grace period, the incontestability clause, the reinstatement, notice of claim, a waiver of premium, guaranteed insurability option, automatic premium loan, accelerated benefits, long-term care. These things you'll see these in policies. Have to be there. You might do it, might not. They'll talk about whether they're in it or not. Accelerated death benefit, additional rent insurance rider, critical illness rider, accidental death rider, policy loan. I know some things are redundant, and there's reasons for that. Might read it differently. Revocable benefactor, design benefactor, non-designated benefactor, trust, maturity. Really? I can leave $1 million for charity. Good. So instead, this is one of those things. So instead of your assets, say you had $10 million, right? So instead of giving them $1 million out of 10 million, you leverage it, and you have a life insurance policy that you might have only paid $10,000 for it, but it's worth $1 million. different world, right? You figure this out. Like I said, as an agent, you're going to get information that you're not going to get anywhere else. Right? Be the guy or gal to go to. Transfer on death, payable on death, monthly, quarterly, semi-annual, annual payments, one-time checks. You can use cash. You can use a check. Electronic payments, credit cards, electronic fund transfers, auto pay, online payment, payroll deduction, ATM. What is not on here? Cashier's check, not on here. Money order is not on here. Cash. Cash is not on here. Why is that? Traceability, Patriot Act. Huh, that's interesting. Long time ago, a long time ago, agents used to go door to door and pick up a couple dollars from somebody to pay for cash, pay for a policy. I'm talking a long time ago, like 1920, 30, 40s. They'd go around and pick up cash. No longer is that the case. You need traceability of where that money's coming from. Anti-money laundering reasons. We didn't talk about that yet, did we? Gotta be in here somewhere, I would think. Lapse policy, reinstatement provision, requirement reinstation, benefit, reinstatement, consequences, reinstatement. Oh my goodness. Cash value, talked about that. Borrowing against your cash value, interest charges, no mandatory repayment. That's pretty cool. So in mine, I have a loan. I worked on my home. And guess what? The interest, it all depends on the contract. Remember this. So this one policy I have has PUA, paid up additions. I paid a lot of money, but and so I have a pretty large, substantial loan on it because I worked on my home, put a new kitchen in. I didn't get a home equity line of credit, right, where you have to pay the money back. So I didn't pay the money back. I'm just paying the interest. No big deal. And what's really cool about this is the interest that I get on my policy is based off of how much money I put into it. Let me say that again. How much money I put into it. So let's say I had 50 grand in there that I put in. I'm going to make interest on the 50 grand. Even though I might have $40,000 in a loan. What? Yes, that's right. But if you had money in a bank, you down the street, whatever bank that you bank at, right? You take your checks, you put it in a bank, and you got an account in there, and you pay your grocery bills out of it. You have a checking account, all that stuff. I'm talking about that kind of bank. That type of bank, you had $50,000 in your savings account. You pulled out $40,000, and now you're going to get interest on 10, right? But on life insurance, depending on the contract, depending on the company and how you set it up, the one I have is if I had 50,000 in there and I pulled 40,000 out, I'm going to get interest payment on the 50. What I call that is your personal bank. Your personal bank. I set those up. Wouldn't you want that? Who wouldn't want that? Wait a minute here, but I can get a better rate of return if I bought this stock. Yeah, you might. Like I said before, I don't put all my eggs in one basket either. I wonder if I had all my eggs in this one basket, like just in life insurance, it's not a good deal, is it? Maybe if I put the money in the market crash, it's not a good deal, is it? So think about these things. Think about these things for you and your client. Interest rates, tax implications. Yeah, now remember, I didn't cash out. I took some money. Impact on death benefit. Now, what's interesting on that one policy I was talking about is, let's say it's a cash. So let's say the face amount is 150,000, and my PUA is at 50. That's at $200,000 that if I died, my wife would get. My benefactor would receive 200,000 minus any loans. So 200,000 minus the $40,000 loan. There you go, plus the interest. So there you go. So instead of 200,000, they would get 160,000 tax free. That ain't too good. Like I said, it's what I wanted, not what you wanted. It's what I wanted to help you get what you want. And I'm just gonna have some education. That's all. I'm not gonna twist your arm or what. I'm gonna give you options. You know, this is what you can do. It's amazing. Once you're somebody that does everything, it's amazing what you can do to help people get what they want, right? So just a term policy. So we just go through here some more. Talked about that a little bit there. Conditions, human interest. Yeah, I just talked about that. Important understanding absolute assignment, conditional assignment, collateral assignment. Oh yeah, collateral assignment. Wonder if I had a business and I got some life insurance and then I want to assign the policy benefactor as the bank for the loan that I just pulled. They might take that as a collateral and I don't have to have any other collateral. Huh, really? I mean, banks do this? Yeah, if I die or become critically ill, the payment would go to the bank to pay off that loan. Huh, on the whatever gizmo I had to have for my business. Life insurance does a lot of things. Okay. So, yeah, we talked about that before. Oh, some redundancy in here. No wonder. What's this? EDP. Accelerated death benefit. How it works. Yeah. If you meet a certain criteria, terminal limited life expectancy can request a portion of the death benefit in often one lump sum. Here's some like 6 months, 2 years. Tax implications, there may be taxable. Depending on the state, depending on the policy. Here, anti-money laundering, there we go. Anti-money laundering. Money laundering, it's basically where, let's say somebody wants an insurance policy and then they turn around and want the money back immediately. Now, it doesn't mean that they they had cash. You know, let's give you some cash. Or they might have opened up a fraudulent bank account, checking account, whatever. You know, and they're going to move. They want to give you the money, and then they want the money back. Now, it's free and clear. It's all cleaned up. Anti-money laundering. You have to go through a course. I forgot. You have to do that course too. Some of these policies. Some of these companies you have to do a course, and it's not that bad. You know, it's pretty simple to go through the course. It's basically just good education for everybody. I guess, did you get all this information? Oh, we're at page 43, thank goodness. Rebating. Oh, yes. Rebating. This is a sticky one. Insurance agents and companies can face penalties such as fines, license revocation, or termination of the relationship with the company if you are rebating. What's rebating? Rebating an agent offering a portion of their commission to the customer. Providing a gift card or discount in exchange for purchasing a policy. Sharing a commission with a customer to lower their premium. Wait a minute, but this is a sticky one. Well, wait. The agent offering a portion of their commission to the customer. But I'm a life insurance agent. I can write my own policy. And that's not rebating. Isn't that the interesting thing? So I give you a gift card or discount in exchange for purchasing a policy. Remember, this is a test, the test. It's very interesting, isn't it? So, like that one company I was talking about that I started out with, as an agent, and I want to buy life insurance, I couldn't buy my own. It'd have to be my upline to do the business on me, and they would get the commission. An agent offering a portion of the commission to the consumer. But as an independent agent, I'm able to buy a policy on myself and get the commission. Huh. Isn't that the weirdest thing? We're talking about general population, general population out there. So my neighbor, I say, hey neighbor, if you want to buy some of, I'll sell you some life insurance, and I'll tell you what, I'll give you some of the money back. Oh yeah, okay. He's not licensed. Not licensed. That's what we're talking about. They're not licensed. Oh, well, let's see, it doesn't say that in there, but that's the assumption. It's if I'm licensed, I can get paid. If they're not licensed, they can't get paid. So let's say you're another agent in another state and you're working a case together. Maybe it's your own case. You're licensed and I'm licensed. You'll be getting a portion of your commission. But this is about a customer that's not licensed. I mean, that's what should state there, but it doesn't. It's assumed. So like let's say we're marketing, we're using somebody as marketing. Well, they're going to give me leads or whatever. Huh. I'm telling you, this is a really sticky one there. This could catch you. Be aware. So, in the anti-rebating laws, okay, misrepresentation. There's churning. Churning is similar practice where an agent convinces a policy holder to replace their existing policy with a new one from the same company, often with similar or worse benefits. Twisting involves replacing a policy from one company with a policy from another company. In insurance terms, they're almost the same, aren't they? But they're different. Insurance terms viatical statement refers to sale of life insurance policy by an individual with a terminal or chronic illness to a third party of lump sum payment, typically less than the policy's face amount, but more than the cash value. There are companies that do this, and there's a reason. There are reasons for people to do these things. Might not be the best thing. And so, it's up to the client what they want. I know of Viatical Company. I have never done business with them. I know of them. They do have reasons to be in existence. And one is they're paying more than the cash value amount, but less than the policy base amount. There are reasons to do certain things for clients. It's not you to decide, it's for them to have, for you to teach them and help them make a wise decision. That's all. Terminal, critical ill, sale of third party, policy sells life insurance, Viaticals done. Some payment, ship. Okay, that's it. All right, we are done. We are done. So questions, pop them over to me. I'll try to answer. And I hope you pass that exam. Come on, it's fine. Stop sharing. Okay. Stop recording.